Welcome to Chapter 12, Investing in Stocks and Bonds. It's pretty much a continuation of Chapter 11. Let's see, learning objectives describe various types of risks to which investors are exposed, as well as the source of return. Know how to search for an acceptable investment at the basis of risk, total return, and yield. Discuss the merits of investing in common stock and be able to distinguish among the different types of stocks. Become familiar with the various measures of performance and how to use them in place of value on stocks. Describe the basic issues, characteristics of bonds, as well as how these securities are used as an investment vehicle, and distinguish between the different types of bonds. Gain an understanding. Where's my little thingy here? Gain an understanding of how bond prices behave and know how to compute the different measures of yield. Okay, how will this affect me? Once you've figured out how much you need to invest to meet important financial goals, it's time to decide which specific investments to buy. This chapter describes the basic characteristics of stocks and bonds, explains the potential return and risks, and provides a framework for choosing among stocks and bonds to meet your financial objectives. Care is taken to explore how stock and bond prices behave and how to evaluate the performance over time. After reading this chapter, you should be able to choose the most appropriate stocks and bonds for your portfolio in light of your goals and constraints. Business risk, the variability surrounding the firm's cash flows and subsequent ability to meet operating expenses on time. Financial risk concerns the amount of debt used to finance a firm and the ability of the firm to meet their obligations on time. Market risk, behavior of investors in the market. Market risk is reflected in the price volatility of a security. And purchasing power risk, changes in the general level of prices can impact the ability of a firm to operate. Okay. For example, the price of lumber has skyrocketed, hit $750 on Friday. It was $312 back in March. So if you're trying to build a house or remodel or anything that uses lumber, your expenses have doubled. And unless you can double your prices that you charge, you're going to be losing a lot of money, especially if you already went under contract or signed bids, contracts to build something at a specific price, thinking that lumber was going to stay the same. And now that it's more than doubled in price, your expenses are so high that you may not turn a profit on what you're working on. For example, if you met with a builder back in March to build a house and you sign the contracts and you're going to pay $200,000 for the house, and the builder put in all their expenses, and normally if the price is $200,000, the builder paid $100,000 for the materials and labor to build the house plus the land. And so now all of a sudden their costs have skyrocketed, so they may not make any profit on this house that they had planned on making $100,000 profit on. Okay. So interest risk, rate risk, changes in the rate will impact fixed incomes, securities such as bonds. Rates increase, value will decrease. Rate decreases, value will increase. So, if you're trying to live on your savings because you're retired and your interest rates are less than inflation, you're not doing a very good job keeping the same lifestyle that you had before, because you're losing money every year because you're not getting the return just to stay even with inflation, let alone ahead of it to actually live off of the interest that you're getting. Liquidity risk, risk of not being able to liquidate an investment conveniently and at a reasonable price. So if you have a baseball card collection or a clock collection or an antique automobile collection, it may be very difficult to liquidate that when you need the cash. Um, so if you wanted to invest in something so that it would keep up with inflation, normally the price of metals, precious metals, is the way to do that. Although at this point I'm not so sure, because if we look at the price of metals over here, markets, futures and commodities, we're seeing, well, gasoline just shot up to $1.31. So here's where you can see if we're getting inflationary pressures. Okay, so we look at oil. You can see that back here, oil was trading, at negative dollars. It was negative $37 a barrel back on April 19th. Okay? Then we went back to normal, but it was still, trading $15, $10, $12. Okay, and so this is just, the end of April, and then we go into May, and it jumps up to $29. Then we go into June. There we go, $37, and then today it's $42. So we went from negative $37 to positive $42. So there's inflationary pressures there. We look at gasoline. Give me gasoline. Come on now. Okay, I'll get to that in just a minute. So let's look at natural gas. Natural gas, you can see, went from here, this is June 25th, $1.49 per million BTUs. That's how it's measured, per million BTUs. To today, it's $2.43. So it went up, 93 cents? Is that right? Something like that, 93 cents in just, 6 weeks? And 93 cents, if you take a percentage of that, you're looking at, 70% increase, thereabouts, of what is. So that's a huge jump in price. Okay, so now we're back here. It was $2.86. So it's still less than it was back in November of last year. But for this year, it's pretty much at its peak. Let's see, it starts off right here at 218, goes up to 220, right? But right now we are at the highest price of this year, 2020. So we are seeing inflationary pressures for natural gas right now. And then gasoline, look at gasoline at $1.31. Well, here you can see back at the beginning of the year is $1.74, so it's much less than there. But then back here, it was 44 cents. So we've gone from 44 cents to $1.31. Again, quadrupling in price. So those are definitely inflationary pressures going from March 25th, 23rd to today. And if we look at back here at metals, let's look at silver. Okay, so here, silver's chugging along right in the mid-teens, 16, 17, 18, and then the virus hits and it goes down to $12.49 an ounce, but now it's up to $26.77, which is more than double that. So you still, even pre-COVID at $18 compared to today $26, that's still a large inflationary pressure, almost 50% higher than it was even pre-COVID levels. And the last one we'll look at here real quick is copper. The reason I like to look at copper is because that's one of the main metals used in building houses, whether it's commercial, factories, uh, manufacturing, anything from dishwashers to um, washing machines, refrigerators, cars. Copper is in so many different things that if the price of copper increases, the price of our finished products increase, especially anything that has to do with a running motor. So copper back here in March 19th was $2.17, and today we're at $2.93. So that's a huge jump. Even pre-COVID, the peak was only $2.87. So we're still higher than we were back then. So there's definitely inflationary pressures when it comes to copper. And then if we look at the 5-year chart, you'd have to go back to 2018, May of 2018, 2 years ago, to get higher than we are right now, which is it was 330 back then. But then, ever since then, it's been peaking at about where we are right now, and then drops. So we'll see if it stays under $3 or if it goes above $3. Go from there. Okay. So let's go back to our chart here. Interest on interest, 4%, 20-year bond. And you can see 4% return, which is a 3% return on an initial investment of $1,000. And then for 20 years, that $1,000 goes to $1,814 for 3% and $2,208 on a 4%. Okay? So you can see the $400 difference in just a 1% change. Now that's $1,000. You can make it 10,000, 100,000, million, and you're still going to have the same change. You just add some zeros. Okay. Unfortunately, as I just showed you, bonds are only getting 0.6 to 1.3% for the 10-year versus the 30-year. Nowhere near either one of these 3 or 4%. Okay. Almost out of time. Let me look at this one real quick. Approximate expected yield, average annual current income plus future price of investment minus current price of investment divided by the number of years investment. All of that divided by the current price of investment plus future price of investment divided by 2. Okay? You can do the same thing just looking it up on an app. It's much easier that way. And then performance of the Dow Jones Industrial Average and NASDAQ Composite 2008 through 2018. And you can see at the bottom here where we had, that's March of 2009. That was the bottom of the Great Recession. And then it's building to back to where we are today, where we're at record highs. The only thing to be careful of is when you're at a record high is usually when you have a large pullback. So at this point in time, it would be extremely risky to invest in the stock markets because record highs usually end with a 10 to 20% pullback. Once they have the 20% pullback, then it might be a really good time to buy. Might be. No one can tell the future. So I'm just giving you, based on past experiences, what might happen in the future, but no one knows for sure. Gains on stocks not taxed until realized, which means you don't have to pay any tax on the increase in the value of your stock unless you sell the stock. And then you realize the profit, and then you have to pay taxes on that. Qualified dividends and long-term capital gains are taxed at the maximum rate. So regular tax is 37% if you're maximum. Capital gains is 20%, and that's if you keep it for more than 12 months. Okay? So regular tax rate 22 minus 35, capital gains 15. Regular tax rate 10 or 12, capital gains rate is 0. So it all depends on what your tax rate is as to whether it's a positive or negative. Okay, there's a lot more to this chapter. Unfortunately, we're out of time right now, but I hope you enjoyed the chapter. I'll see you next time.